Yianos, what's happening here? Why the underperformance in Europe?
Well, it always depends from your perspective, right? Whether you look at it under common currency or from the home currency. So I think in general we'll find that in common currency terms there is attraction, and we're talking about a global phenomenon here. And kind of the distribution of the returns is essentially happening with the currency at the end of the day. So that's an explanation. It's a differing performance on the currency front. And to some extent, one could argue that you might have different speeds in terms of closing the output gap here, and that will affect, I guess, the behavior between the different equity indices. But overall, if you take a closer look, I think the most important characteristic is that there is a lot of movement now in equity markets. So, you're going to have blips, but I wouldn't ascribe particular importance to those at this stage. We haven't heard drastic moves in the last few weeks in currencies that would justify a departure.
Well, fair point. And Shahab, then to your role, what part of this has to do with the stronger euro that we've seen, and what part of it's removed from it?
Well, as Yianos says, definitely the strong euro has been a feature of the whole year. That has to be accounted for when you look at relative performance of equity indices. Going forward, in our view, euro will continue to go higher. So that's something to consider here. We think the euro, because of the 3% or so of GDP current account surplus that's backing it up, effectively, when you combine that with very strong growth numbers that we have in countries across the euro area right now, the natural path is to go up. So these wide rate differentials that you have, let's say, between the US and Germany right now, they're almost a prerequisite to stop the euro going up, as opposed to a reason for it to go down. So we think any equity investor really has to take account of a stronger euro in their forward-looking plan.